Welcome to Telltales, an investing podcast hosted by Hunt Lawrence, Jason Wallace, and Mike Nicoletti. Each week, we discuss topics ranging from geopolitics and macroeconomics to energy and technology. You can sign up for our newsletter at telltales.us. That's TELLTALES.us for additional data and content you can use to follow along. The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Can we get started?
Yeah, I think so.
On oil, the demand supplies, Exhibit C, starting from the back of the 20 pages, the demand supply hasn't changed very much, except that the Ukrainian drones have Russian production down by at least 1 million barrels a day. And the thing about Russia is that they export crude, but they export a lot of distillate or crude oil, kind of the middle of the barrel. When these refineries go down, that they don't produce distillate. And I don't think their facilities are flexible enough to export the crude that's not being run through the refineries. So this 1 million barrels a day decline in Russia is probably going to be sustained. And that's definitely tightened up the market. The other event that happened in the news is Israel, with a drone or a missile or something, assassinated the Iranian general. Their forces outside of Iran are called the Quds forces, who was in charge of their relations with Hezbollah, which is the militia that basically governs Lebanon and which is engaged with the Israeli military in northern Israel. They promised actions, and that definitely stiffens up the oil market. Increased political risk, but we'll have to see in the next days or couple of weeks what happens. But WTI is at $85, and it is still an oversupplied market. If you look at Exhibit C, Saudi Arabia is down under 9 million barrels, and they can produce 11. And probably, as I say, it helps have Russia off by about 1 million barrels a day from 10 to 9. And then UAE is probably holding back about 500,000 barrels. So if that oil were not curtailed, we'd have a significant oversupply problem. But so far, so good for the oil market. $85 is pretty fancy price. Exhibit B, natural gas. As I reported last week, production is holding in at 102. That's terrific. The estimate here on Exhibit B was 104 for 24. That it reached 104 late fall last year, but 102 is terrific. The one thing I think that's been in the news, and I think Jason pointed to this last week, is that power demand, which went up by about 2 Bs a day in 22 and about 1.5 Bs in 23. It's projected here to go up 1.5 Bs in 24. A lot of that's driven by data centers, and there's a lot of publicity about how data centers are going to require more energy. Now, there's more wind and solar all the time. Wind and solar aren't that much of an impact. Texas has more wind and I think more solar even than California, and it's still only like 14-15% of their total power. The demand increase in power rivals the demand increase in LNG. Another interesting thing from a political point of view is they're talking as the House comes back from their spring recess or Easter recess. They're talking about doing a bill on Ukraine. And the speaker has said one of the things that might be added to that bill is pulling the DOE's limitation on taking more applications for LNG plants. That would be very useful. Natural gas pricing is still, $3.50 next year, maybe more in 26. And so that would be welcome. I mean, just look at the progression in natural gas prices in 2020 got down to 220 from 270 the prior year. In 21, pretty good recovery to 370 and $6 with the Ukraine invasion in 22, 275 and 23. We're thinking 280 this year and 350 next year. 280 is a lot more than 250, but we do think it'll start to improve. On the macro money in and money out cash flow statement for the federal government, Mike and I were talking this morning. I'm hopeful now, based on doing regular order. In other words, getting those 12 expenditure bills done, even though they were done halfway through the fiscal year. Hopefully they'll get after them and do it in more. Our next fiscal year starts next October 1. Hopefully they'll get them done before that or not too far into next. I think by going through these 12 expenditure bills, I think everyone realizes that the amount of overspending during COVID is just intolerable and drove the national debt up, and probably it was at least half responsible for the inflation that ensued. If they could just flatten that deficit out at $1.4 trillion, it's not perfect, but these numbers go $1.4 trillion, $1.6 trillion, $1.7 trillion. Be much better to flatline at $1.4 trillion, and hopefully that's what comes out of it. Just a prelude, we're going to talk about China today. Having done antitrust last week, we're going to go through just about everything we have in these 20 pages and assess China risk. But before we do that, Mike or Jason, anything to add?
I would just say, this conversation about China risk, it adds extra complexities with it being an election year. So, there's a lot of hanging questions. So I think this is a good exercise, but the long story is we don't know what's going to happen with the election, and that will also be important.
That's a great point. Jason, you're our principal expert on China, so we're going to call you quite a lot. Let's do this kind of an interesting thing. We haven't done this in a while, and this just occurred to me. Let's start with page 20 and just cite across and say, these companies, do we see any significant China risk? I'd say, no, I don't see too much risk on page 20. Uber, DoorDash, Airbnb, Five Below, and Etsy.
I'd say Five Below probably has quite a bit of risk there because
of the material coming from there.
Yeah, everything they sell comes from there. And then Airbnb actually does a good bit of business with China-sourced travel. I don't know what percentage of the revenue it is, but Chinese people leaving mainland to go elsewhere.
I think Uber used to be in China, but I think they withdrew.
Right. Jason, do you remember, do they still have a stake in, what's it called, Didi?
That I don't know.
Yeah. They might have a stake in that.
Yeah. Page 19. I don't know, Jason. I don't see anything in this healthcare stuff. I mean, I know some of the raw materials to make pharmaceuticals come from Asia, but I think they're as likely to come from India as China, aren't they? I mean, I think China ships us the ingredients to make fentanyl, or ships them to Mexico or something, but I don't see too much China risk here.
Yeah, nor do I. The only thing in the news lately is a Chinese company that's a CRO, which is a contract research organization that runs clinical studies, has been in the news for funneling some IP back to mainland China. So, but how much business these guys do with that organization is probably pretty minimal.
Yeah. Page 18, Freeport's the largest copper. I think it's the largest public copper producer. Albemarle is lithium. Awful lot of lithium gets processed in China. So I don't think that's necessarily positive for Albemarle stock. CF is ammonia. I think they're reasonably independent of China. I mean, obviously China produces ammonia for their farming activity. NextEra is energy, utility in the U.S. and lots of wind and solar. I do think solar development is impacted by China because almost all the solar panels are made in China. So if somehow we curtailed, put high tariffs on solar panels, it definitely would affect solar development. Anything else, Jason or Mike?
No, I guess to add on that, nearly all of the lithium is processed in China, and we'll touch on it when we get to the Tesla page, but EV demand in China is falling even more rapidly than it is here.
Yeah, that's true. Golly, page 17, FedEx and UPS, some amount of their activity must be to and from China. Nike, I guess, makes everything out there. Costco might have a little bit of a Five Below problem. Some of the Costco stuff may be made in China, but I think that's across the board on all retailers.
Yeah, I'd agree with all that. I mean, Nike's supply chain is a lot of Indonesia too. I don't know. They seem to be having issues of late. I think the stock's actually sold off. It's historically commanded a pretty high multiple. So because of the quality of its brand, but if it were to get cheap enough, it would probably get interesting.
Right.
Yeah.
Right. I think they've had some product market fit issues.
More competition too.
Yeah, changing consumer behavior.
Yeah. McDonald's operates everywhere, so they have to have stores in China. I don't know about Starbucks.
Yeah, absolutely.
This North America, Celsius, yeah, that's all U.S., I think. Hilton's kind of in the business of franchising hotels. They probably have some China exposure somehow.
There are 789 Hilton hotels in China.
Holy smokes.
Yeah.
Holy smokes. The neat thing about Hilton is they don't own any of those things. They just kind of franchise them.
Right.
Hilton's kind of an interesting business. Too expensive, but interesting to follow for sure. One of the things we're going to see is it's the two largest economies in the world. So there are a lot of links to China, where places that you might not expect to see. Holy smokes.
Yeah.
Holy smokes. And they don't, the neat thing about Hilton is they don't own any of those things. They just kind of franchise them.
Right.
Hilton's kind of an interesting business. Too expensive, but interesting to follow for sure. Page 15 is the other healthcare page. Pfizer, Moderna, LNTH, BioNTech, and Vertex. I don't know, Jason, but presumably some amount of U.S. pharmaceuticals get exported to China, but I just don't know how that affects a large company like Pfizer. I can't imagine it's too significant impact.
I doubt it. Yeah, it's there's some amount of crossover, but they have a pretty healthy, domestic pharmaceutical business.
And then remember
industry.
COVID, they did their own COVID. So they might have in time made a deal with Moderna or BioNTech or something, but they kind of insisted on doing their own vaccines.
Yeah, they resisted the methods we were using to build vaccines for a long time.
Right. Here's an interesting one. Caterpillar, Deere, both of them have to have significant operations in China. Generic TransDigm, Fastenal. Fastenal, of course, stuff has to come from China, I would think. Some of the stuff they sell. Just for those who are on the phone or unfamiliar with Fastenal, it's the company we like to point to as being one of the 20 best performing public offerings ever. If you had the presence of mind to put $9,000 into Fastenal 30 years ago when it came public, I think your dividends and market value and whatnots were $7 or $8 million. So you can find the right company and put a little money in it, it really can turn into a lot of money. They're a retailer. As their name, they basically even now, 3 years after they came public, half of their sales are fasteners, saw blades and things like that. Really superbly run company. CAT has exposure everywhere, but I just don't think that they're, if China turned into Russia, I don't think it's going to have that much impact on Caterpillar. The interesting thing about Caterpillar is they stood off all competitors, Japanese, Chinese, whatnot, people who run construction projects or want diesel engines or whatnot, or use oil field, they really pay a premium for that Caterpillar brand. 13 is JP Morgan, Morgan Stanley, Goldman Sachs. I mean, they'd be dinged a bit, but I doubt if I think they can protect themselves pretty well. Any thoughts on that, Mike or Jason?
Not really. I do know that most of those banks have operations over there, but I think it's more on the private wealth side than it is on the iBanking.
The gas companies, page 12. I mean, they're dependent on LNG exports, and China's a pretty small portion of total LNG exports. I mean, obviously Europe's pretty dependent of it. After the invasion, they don't use as much Russian gas. They filled in with LNG. The Gazprom, to try to make up for not having as much sales into Europe, has built pipelines to China. I don't think there's too much impact on the gas companies. On the oil companies, page 11, once again, they're all North American based. And to the extent that China going down with, or getting in a situation where there's some kind of tariffs or quotas or whatnot to try to penalize China, I don't think it impacts the price of oil too much. The midstream companies, there again, don't see any real exposure to China. The Exxon, Chevrons, Conoco, Oxys, I frankly don't see that much exposure. It's interesting that China has some large oil companies which rival the size of these companies, and they more or less do the refining and marketing within China. Anything else, Mike?
No, I mean, maybe some impact to Cheniere, obviously, but presumably that would just get shifted around.
Even Cheniere, I mean, the take-up by LNG in Europe to replace the Russian gas is such that I think it more than makes up for China. And I think the largest consumer of LNG in Asia is Japan or Korea. I think the Chinese use as much LNG as China or Korea do. The retailers, good point Mike and Jason made about Five Below. I mean, for these retailers, here we're on page 8, Walmart, Target, Lowe's, Home Depot, CarMax. I don't think CarMax is too much impacted, but I mean, all these companies do market things from China.
Yeah, with Walmart and Target being the particularly vulnerable.
Yeah.
The thing to think about is Trump's proposed 60% tariff. You can imagine how that would affect these companies. Hunt and I've talked about this in the mornings occasionally, and we both sort of believe that it's kind of a bargaining chip. He's anchoring a discussion. So maybe it's not something to over-index yourself to, but it is something to be aware of.
Yeah. Payments companies, I kind of concluded PayPal just is never going to be like MasterCard or Visa. MasterCard and Visa are two of the great investments ever. I think they, have some impact, but I don't think it takes them too far off course, to use a sailing term. AT&T, Verizon, T-Mobile, the phone companies, they probably have some exposure to China, but maybe equipment gear coming from China, I don't know. But I think the neat thing here is these companies have started to phase down their CapEx, so they're not growing that much, but their free cash flow is up in a significant way. Charter and Comcast, I don't see too much exposure there.
Okay, let's take a quick break for a message from Oak Cliff Sailing.
Hi, I'm Dawn Riley from Oak Cliff Sailing, and it is springtime in the Northeast. We promise it's going to get sunny, but this weekend we have an art show, and inside here we have a brand new epoxy floor that is being done. So we hope to see you on Saturday, and if you can't make it, you can go to oakcliffsailing.org and go to shop, and you can buy artwork that is not sold on Saturday. We hope to see you here soon. It will be sunny.
And now back to the show.
When we get to page 4, I suppose Netflix, I mean, they have users everywhere. So I guess they have users from China, but I can't imagine it's too big a percentage of their revenue.
Actually, I don't even know if they have operations in China.
Yeah. Disney, of course, has a Disneyland in China, in Shanghai, I think.
Yes, definitely. Actually, Disney's fairly large in China, certainly popular.
Yeah. Facebook, I assume Facebook or Meta doesn't operate that much in China. That's more the Tencent, they're kind of displaced by Chinese companies. But
well, that's part of the rationale for getting TikTok out of here, is that they won't allow Facebook or Google or
yeah, there you go. So. Yeah, and Trump takes a position that legislation trying to eliminate TikTok or cause them to sell is not a good idea, because it'll put Facebook and Instagram and whatnot in kind of a monopolistic position. It's kind of an interesting take on the TikTok controversy.
Yeah, I think it's a bad take. There's a lot of competition for eyeballs with social media and other platforms that just removing one competitor shouldn't affect it too much. And I have pretty strong opinions about TikTok, so.
Yeah, we get to we only got about 5 or 6 minutes left. Now we get to the meat of the issue. Impact on page 3 of the chip companies. Just can't see that any of these companies benefit from confrontation with China. The problem is confrontation with China is kind of a bipartisan thing. I mean, both you hear from the Biden campaign, from the Trump campaign. But Jason, who do you think is hurt worse if there's some kind of a military move by the mainland on Taiwan, and then response from U.S. and other, I don't know whether it would turn into total the way we treated Russia or whatnot, but I mean, presumably everybody gets hurt.
Yeah, absolutely. If there's military action, everybody gets hurt. I mean, we're all dependent on Taiwan Semiconductor. And the more we push China away from that, the less incentive they have to protect those assets if there ever was a confrontation. So right. Barring confrontation, I think on this page, ASML has by far the most exposure. They sell the majority of their machines by count, I think, likely go to China. They sell a lot of their lower technology, older fab production machines there. And that's where a lot of their growth has come from. We talk about all the EUV and high NA machines that cost hundreds of millions of dollars each, but they're kind of bread and butter is the $20 million machine that makes commodity chips that they sell hundreds of to China. So that's a huge risk to them.
And are planning to ship a lot more over the course of the next 2 years.
Absolutely.
Right.
Yeah. And NVIDIA, all of the run-up we've seen in revenue in NVIDIA, none of that's really been China at all, because we imposed those sanctions probably 2 years ago now.
Right.
The flip side is those chips are packaged in China.
Yeah.
So, there's still quite a bit.
Just run it through that. That's the amazing thing. We talk about this, trying to not be dependent on China. And I mean, is it like 90% of all the packaging happens in China? I mean, it's a huge percentage.
Yeah, it's some very large percentage. I mean, more of it's shifting to Malaysia and some of these other, Vietnam and some other alternative locations, but the vast majority happens there. And the semiconductor industry has been global almost since its beginning. So it's probably the most international and geographically unconstrained business that there is. So any of these geopolitical tensions are going to affect semiconductors the most.
Yeah. And there's weird choke points in the semiconductor supply chain all over the world. So,
yeah. And you look at this list and you might say, oh, well, Intel's probably safe. Maybe. I'm sure there's parts of their production process that don't occur in China. And if you remember, Gelsinger was, publicly saying, hey, wait, we can't not sell to China. That's a big chunk of our revenue. Well, I think China's taking care of that for them as well by saying we're not going to use Intel chips in our state-owned company computers. So it's an issue for everyone.
Yeah. I think the software companies are kind of insulated a bit.
Yeah, I bet Oracle actually does a pretty decent China business.
Oracle hosts TikTok, don't they?
They do, yeah.
Can probably do it at a low margin, but then we come to page one. Just in order of magnitude, I would say that Alphabet's probably the most insulated. Don't you think of the three
Right.
Apple, Amazon, Alphabet, Microsoft, and Tesla?
Yeah, I'd agree.
Definitely,
with that.
yeah.
Microsoft does a good business in China,
Yeah,
which maybe will start to go away.
yeah,
Apple,
Maybe.
obviously, is very dependent.
yeah, yeah. All that stuff about moving things to other places in Asia, I think is happening at a very slow pace and extremely difficult because you not only have to move your assembly operations, which Foxconn and others do for them, but you have to have the component suppliers.
Yeah, and labor and talent, and so
Right.
these things take time to develop.
Sure.
And then I've always thought, like, sooner or later it happens. If China builds up their middle class and the standard of living increases for the whole population, then there's going to be lower cost labor centers in somewhere in Southeast Asia. So
The issue with Amazon, I guess, is the same as the other retailers. Just an awful lot of stuff that Amazon does, that Amazon markets, is made in China.
Absolutely.
yeah, a lot of the electronic, kind of smaller budget consumer electronic items.
Anything made out of plastic.
Yeah.
I mean, the percentage of products that are made in China is very, very, very high.
Definitely.
I actually think Amazon's they're at a pretty large risk, right? And what would be the impact? The price of everything on Amazon would go up. I think people still would buy most of it if it were 60% more expensive. So it really just drives inflation.
Happy Amazon stockholder. I think all their logistics and the one-day delivery, no matter what the price is, I think it's pretty hard to compete with Amazon.
They've been rolling out same-day prescription delivery in a handful of cities in the U.S., and I think just last week they launched New York. So prescription drugs delivered to your door the same day.
Yeah. But we can't just beat up an Apple. We have to consider that Tesla does about a third of their production in Shanghai.
Right. And there's now zones in which you are not allowed to drive a Tesla for security reasons. That's a headwind for sure.
And these are zones in China?
Yes. Yeah.
Wow. And that's to try to help BYD and the others, or what exactly is going on there?
Well, they claim it's a security issue because the U.S. government could utilize the cameras and other technology on the Tesla to be a spying device.
It's their version of our complaints about TikTok.
It's maybe no surprise that it's
Right.
pretty much the same arguments that we have.
Right.
And if they're worried about it, does that mean they're doing it?
And vice versa.
That's funny. Jason and Mike have done a lot of work on Tesla. I paid some attention to it. They're trying to figure out, with their deliveries in the first quarter, announced, I guess, yesterday or today, the less than the first quarter of 23. And BYD, their principal competitor in China, and increasingly probably in time worldwide, also had lower deliveries.
Yeah, BYD for a period of time was the largest EV manufacturer. But their sales declined so rapidly this past quarter that Tesla retains the crown.
We'll end this Wednesday, and we'll begin next Wednesday, because we can start from the beginning of the 20 pages next Wednesday. Can Tesla trade down to 100?
I mean, anything can happen.
No, I know, but I mean, let's just talk about 100 because it's a round number. There are 3.2 billion shares outstanding. So at 100, that would value Tesla at $300 million. And it's a stock that, I don't know what the all-time high was, but 52-week high here is 300. For their fiscal and calendar 23, they had $5 billion of free cash flow. So even at and they have more cash than they have debt. So they're fiscally very sound. 28 billion of cash at year end and only 2 billion of debt. So there's no kind of, but cash flow, I mean, they're very sound financial balance sheet, much sounder than, I don't know about Toyota, but much sounder than the U.S. car companies. But at 300 billion of market value on 5 billion last year of free cash flow, it's still a pretty high multiple times free cash flow. Or put another way, if you start to get kind of more a car multiple on this of like 15 times free cash flow, you'd have to see yourself clear to not 5 billion of free cash flow, but 20. And I think, as I say, we'll end this week and begin next week with that. But I think there is a case for 20 billion of free cash flow from Tesla. But over to you guys for a closing comment.
So the first thing I'll point out, and this is something that maybe we do on our own one-pagers that we do on these companies, slightly different than the one that goes out, is we break out what is reinvestment of cash flow and what is kind of just sustain the existing level of cash flow. So if you do that, you end up with an adjusted cash flow figure that's closer to 10 billion for last year. And that's because they're spending so much money on increasing capacity. So even then, you're still at a higher valuation, significantly higher valuation than traditional automakers. So you have to have an idea as to where this business is going to operate in the future. And at a high level, we think it's going to run at a 10% operating margin. And we see it producing easily 4 million cars a year. I forget our exact year we predict that, but you back into a cash flow figure from there. So over the long run, we think this thing will do quite well. But I think in order to properly kind of understand what's going on, you have to get comfortable with the fact that the company's reinvesting its cash flow.
I got a great way to close here because we're running out of runway here. Musk says that Tesla will compete with Apple. In other words, your EV will be as important to you in terms of communication, personal use. You'll be as committed to it as we are to our iPhones. Apple had 88 billion of free cash flow last year, so maybe 20, even done my way, the old-fashioned way, where you count all capital spending. Maybe it's feasible. It's certainly, to say that Tesla's like any other car company is just kind of missing the point. I mean, they've got a much stronger balance sheet. They have much stronger margins. They seem to have much better engineering and just general competence. Neither of you disagree with that, right? In fact, I say 100. I think Mike and Jason, for their work, probably come in at 150. So that's what we'll get into next week, is how to think about an entry point for Tesla. That's a good way to leave it.
Yeah, and I'll be in New York next week, so we'll do that.
Yeah, there you go.
Live.
Yeah. Mike will be there, pushing me up, arm wrestling or something, trying to get me off my $100 number. Take care, everyone. Have a good week. Be well and stay healthy. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to and no reliance should be placed on the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future and may or may not hold positions in the securities mentioned.